Hello and welcome to this week's edition of the Retirement Compass, the show dedicated to helping you successfully navigate to and through your retirement. I'm your host, Kristen Oakley, and joining me in the studio are two members from Stonebridge Wealth Systems. We have Tim Kulhanek, who is the co-founder, and Jeremy Gove, who is a partner. And of course, you both are financial advisors. Great to be back in the studio with both of you, Tim and Jeremy. How are you this week?
Doing pretty good, thanks.
Good. And Jeremy?
Very good, thank you.
Well, good. Well, I know you've put together a really fun show. It's going to cover a lot of informative things that our viewers need to be aware of and this economic climate. But we want to start off, the title of today's show is how much time off can you afford to give your retirement accounts? Now, what are we talking about here? Well, I have some statistics to share with you as we kick off today's show. Since 1950, the S&P 500 has experienced 15 bear markets. That means that there's been a decline of 20% or more in the stock market, and this is according to research from Forbes. More common drawdowns of around 10%, which is known as a market correction. You might be familiar with those terms. That's happened 39 times over that same period of time. And so of those 39 corrections, 11 have turned onto full-on bear markets, meaning, again, that decline of 20% or more. And so this brings us to what we're talking about. How much time off can you afford to give your retirement accounts? Now, Tim, help us set up the context of today's show when you're using that phrase of time off with your retirement accounts. Because really our viewers, when they think time off, they should just be focusing on taking vacation in retirement, right? But what do you mean by time off with the retirement accounts?
Sure, good question. So I think the way to frame this is to say, yes, it should be you, the retiree, our viewers, as they plan for retirement, getting ready to go on vacation. You know, this year the Olympics, so maybe somebody has on their bucket list to go see, you know, the swimming and diving competitions, whatever it might be. That's really what folks should be able to focus on and doing, right?
Yep.
But over the last 20 plus years, it's been a lot more challenging. We've had a lot of different peaks and valleys in the market. So think about it this way. If you owned 1 million shares of a company, you guys might remember this, remember the sock puppet from pets.com? Mm-hmm. Yeah, the sock puppet was actually way more popular than the company as a whole. So if you owned 1 million shares of pets.com during their IPO, which stands for initial public offering, in February of 2000, that came out at $11, you were worth $11 million. So pretty cool deal. Mm-hmm. By January 1st of 2001, the following year, you were broke. Mm-hmm. Money was gone. And so it's one of those discussions where, like, wow, that just emphasizes and really illustrates how volatile and risky capital markets can be. Mm-hmm. Now, that's, some people might be saying, Tim, that was back during the tech bubble. Mm-hmm. You know, that's long, old history. Give me something more recent. Mm-hmm. Sure. So I actually experienced this with my own eyes. Just take you back about 4 years ago to 2020. Mm-hmm. We all remember what happened when, you know, the pandemic hit. Yep. And we had really wild swings in the stock market. I was actually out of the country at the time, so that was a wild experience, especially the travel back, because I had left the country and everyone's like, oh, there's some sort of thing going on, we're not really sure. But by the time we're on our way back, it was like nobody wanted to stand next to one another in the airport, and everyone's like looking sideways if you sneeze or you cough.
Right. Yep.
Well, the other thing that happened was pretty much the entire stock market got battered. It was the fastest decline of 30% or more in history. Mm-hmm. So it was about a 35% decline for the S&P 500, which is just a large, broad market index. Right. One of the stocks that I was following at the time was Eldorado Resorts, because I've got a client who works for them. Okay. Now, they've since merged, and there was a combination of companies, and now Eldorado Resorts is part of what's called Caesars Entertainment. So for our viewers out there, if you've ever heard of Caesars Palace, that's that same company, right? One of the largest gaming and entertainment companies in the entire country, right? Yep. So here's the stats. On February 19th, 2020, Eldorado Resort stock, which was ERI, if you want to look this up at home, was valued at $69.47. Okay. Less than a month later, March 17th of 2020, $7.77. It was like a 90% decline in less than a month. Wow. It was the craziest thing I've ever seen. You're just sitting there watching it, and you're like, oh my gosh, surely it's bottomed out. Yep. And it just kept going down. Yeah. And thankfully it eventually recovered, like a lot of different stocks have, but again, it illustrates just how unpredictable, volatile, and even irrational capital markets can be. And it's a reason why, econ professor, and he was actually chief economic advisor for a previous administration, Jason Furman, he says that economists, because this is kind of tied together, the market and economy. Economists exist to make astrologists feel more reputable about themselves, right?
That's
and better
a funny
about themselves.
quote.
It just shows that economics and the market dynamics are very difficult to predict.
Yes, they are very unpredictable. And I love, you use the term whipsaw, that the markets can just whipsaw back and forth, right? Willy-nilly it sometimes feels like, and it can happen just like that example you just shared. You know, I think a lot of viewers are also very familiar with Enron, you know, Radio Shack, Blockbuster, Lehman Brothers, all these things that have really caused a lot of volatility and big swings and quickly in the market. And so I can imagine some folks who are listening today are going, well, yeah, this is why you don't invest in individual stocks, right? Because if you do that, that could be very risky. So this is why I just put all my money in a mutual fund and I spread my risk out. So what would you say to someone who's saying that right now?
Yeah, I mean, I understand the point. I think it's a good point. And it's true that individual stocks are going to be riskier. So I wouldn't say that there's anything wrong necessarily with investing in individual stocks. It just goes back to don't put all your eggs in one basket. You know, you want to spread that out. But individual stocks are subject to what we call unsystematic risk, or in other words, company-specific risk. So something could happen within one company like it did with Enron, Blockbuster, Lehman Brothers. That takes that one company down, but maybe not the entire market. So let's take a step back and just look at broader market indexes then. So what if I just put my money into a basket of stocks? Because that's really what a mutual fund is, right? Think of it like, for our viewers at home, think of it like a big bucket and just fill it up with all types of different stocks, right? So it could be large company growth stocks. So it's going to have more of your tech names and that sort of thing. So if we look at an index that tracks those types of stocks, we could look at the NASDAQ Composite Index, okay? And there's about 2,500 individual stocks that fill up this bucket, okay? Now, that was valued at 5,048 points in March of 2000, all right? So again, we're just being historians right now. By December of 2002, it had dipped down to 1141. Not good. By March of 2009, okay, so we're 7 years later, it's at 1268, okay? Get this right, March of 2015, it was finally back to its value from 15 years prior at 52. So it took, when I'm talking about, you know, the topic of this show is not letting your money take a vacation. How many decades off can you go without having any growth in your portfolio? Right here is 15 years. Now today, that index is trading at a whopping over 16,000, 16,195 as of this recording.
Right.
But if you think about it, another way, investors could have essentially put their money in a savings account over that 15-year period, ending in 2015, and been better off because better off not only financially but also emotionally and mentally and physically because of the toll it takes on you with that roller coaster and the unknown and the worry.
Well, and I think there's probably some people that are listening to this conversation today and going, yeah, I don't want the roller coaster. I don't want those significant ups and downs. And so maybe I should just not deal with the stock market at all. So Jeremy, what would you say to someone who's maybe thinking that as a result of what we're talking about?
Well, I think it's definitely easy to be scared when markets are going up and down. You know, you mentioned whipsaw. Nobody likes to be whipsawed, right? Nobody likes that whiplash effect, the ups and the downs. And excuse me. So I think it's important to look at the data. You know, we like to make decisions based off facts. And so if you look back through history, you know, to kind of go along with what Tim's talking about, the reason that people should invest in stocks, we want to keep up with inflation. A lot of investments don't. So, you know, savings accounts probably don't keep up with inflation. And so if you look back, the past 96 years, the 1 year win rate is 73%. So
what's
that means
the 1 year? Just define what the 1 year win rate is.
So the market was up 73% of the time over the last 96 years for 1 year. But if you look at the 3 year win rate, it was actually up 84% of the time. There was an 84% chance that you were actually positive. Bear markets are not that common. What is a bear market? A bear market is the market's down over 20%, right? If you look back through history, of the last 39 corrections, 11 of them were actually materialized into an actual bear market.
Right.
So that means 28 didn't. Right. And so I think that's just the important part of it. There's a lot of like you said, whipsaw. There's a lot of things going up and down, but that's part of why it's good to have an advisor who's not emotionally tied to the money.
Right.
Because when you're emotionally tied to it, it's easy. The market starts coming down, I want to sell.
Yes.
And so what you end up doing is you're selling at a low point.
Yeah.
And then the market goes back up, and now you're starting to feel good. I should be in the market. You buy back in. And what do? You buy back in at a high point.
Exactly right. And that's why sometimes we're too close to our own stuff, and folks run the risk of making fear-based decisions out of emotion when we are seeing that volatility happen. So what's the solution? What do we do to this answer of, like, can my money afford to take this time off? Because we can't. Here's the problem. Yes, not all of these corrections have turned into bear markets, but what if one's happening right when you plan to retire? You can't control the timing of that.
Absolutely, and that goes back to the sequence of returns that we've talked about on past shows, the fact that losses hurt more than gains help, the fact that if the bad returns hit early on, like imagine if you were a retiree in the year 2000.
Right.
It didn't work out very well at all, and for a lot of those folks, if they were trying to take 5% per year and they were invested all in equity markets, such as a S&P 500 index fund,
Yep.
They ran out of money in like 18 years, and we don't want that. But sometimes what happens when markets are going good is we kind of lose sight of some of these statistics. So I think it'd be a good time for us to revisit. I think we got a photo that we're going to pull up on the screen here just for a second. Revisit our good friend here. He's on the right there, folks. And this is our dear friend, Captain Edward Smith. Now, Jeremy, Kristen, do you remember who this fine gentleman is?
I do. Do you, Jeremy?
Maybe.
He's the captain of the Titanic.
Well, he was, right?
So, sorry.
That
Sorry,
didn't
that was
last very
bad.
long.
Past tense.
Yes.
So on April 10th, 1912, Titanic set sail on its maiden voyage from Southampton, England to New York City. But did it ever make it to Pier 59? No, it did not. Now, why didn't they make it is the question. And obviously we know they hit an iceberg. How many people were on board? Over 2,200. How many survived? Only about 706. What can we learn from this, and how the heck does this involve anything with the financial markets and planning for retirement? Well, here's what it involves. Did Captain Smith know before the voyage that there were not enough lifeboats for all the passengers and crew?
Yes.
Yeah, he did, right? Was the crew properly trained on how to use the lifeboats to and fill them to maximum occupancy?
No.
No, they were not, unfortunately. Was Captain Smith warned about the presence of icebergs in their field of travel before they set sail, or as they were setting sail?
Yes.
Yes, he was. Did he, given all that knowledge, slow down or plot a different course? Obviously, he did not. The question is, why not? And we all know the answer to that, which is Titanic was
Unsinkable.
unsinkable. Sometimes when things are going good with our investments, we start to feel a little bit like old Eddie Smith. And we know there are potential dangers out there. We know we should listen to the warning call, but sometimes we feel invincible. We feel a little bit unsinkable. Again, I think what we have to focus on, folks, and for our viewers out there, just remember that markets are efficient. They're unpredictable, but they tend to go up. We don't want to be all doom and gloom, but at the same time, we want to make sure that there's a plan in place to deal with these types of normal corrections, to keep you invested, to keep you from bailing on the plan, and also to make sure that we don't get a little bit too ahead of our skis, get too overconfident, and start doing things like Jeremy was talking about, where we're buying more and more and more where things are going good, and then selling when things are going bad, and just repeating that process over and over again. If you've got a trusted ally in your corner, like one of our elite advisors at Stonebridge, we're going to help you stay committed to the plan. It all starts with a complimentary written financial plan, which you can get today by calling the number on the screen.
Tim, Jeremy, thank you so much. To our viewers at home, that number to call to get your complimentary written financial plan is 866-256-7778. Or if you'd like to connect online, you can pull out your smartphone, and if you open up that camera app, just point, click, and scan the QR code that you see there down in the bottom right-hand corner of your screen. That will take you over to a landing page, ask you a few short, simple questions, and then a member of the team from Stonebridge Wealth Systems will reach out to connect with you to schedule your complimentary written financial plan that way as well. We'll be back with more on today's episode of the Retirement Compass right after this.
I own a motel I was able to buy out of college. When I actually ended up buying the motel, I was leaving. I had just passed the life and health license, and I was going to sell Medicare supplements and long-term care. I told the owner of the motel that, hey, I'm going to be leaving. I was giving him a 6 months heads up that, hey, I'll train whoever you want to bring in. He said, I'd actually rather sell you the motel than bring in a new manager, because he never showed up. So he didn't have to do anything. It was kind of like an ATM for them. And so, when you own your own business, there's a lot of people that got to be paid. There's marketing that has to be done. There's a lot of different dynamics that go into running a motel. It actually taught me to think outside the box a little bit. And so I started looking around, what are other things I can do? Because I really liked helping people. I liked solving problems for them. And there's a big difference between selling something and actually finding solutions to problems. When you're thinking about personal finance and managing somebody's retirement for them, they've worked for 40 years saving all this money and now they're retiring. They're turning this over to you to take and run with it. So it's a big deal. I think we can always do stuff better. There's always room for improvement. And so I want to read as much as I can. I want to study as much as I can so that I can do a better job for my clients, which they're counting on me to get the job done for them.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with both Tim Kulhanek and Jeremy Gove from Stonebridge Wealth Systems. We're talking on today's show a lot about market volatility, and of course, a lot of folks are concerned because we don't know when the market might have another correction, when it might become a bear market. We want you to be prepared for that. You shared earlier, Tim, in the show, you went over how the NASDAQ took a 15-year vacation, if you will. That's how you put it, for investors between 2000 and 2015. Now, some of our viewers might pick up on that and think, well, yeah, sure, that would be because the NASDAQ might be more aggressive since it has a higher allocation towards tech stocks. So what would you say to someone who's thinking along those lines?
I'd say that's naturally what I would say, because we're all, we want to avoid pain. We want to make sure that, we're okay. One of the questions that we get when folks come in is, hey, am I doing everything that I should be doing? Am I going to be okay, right? I go back to the main questions we get are things like, when can I afford to retire? Will my money last as long as I need it to?
Right.
And will my family be okay if something happens to me?
Yeah.
And so we hear these kind of concerning statistics and we're like, oh my gosh, well, what if that happened today?
Right.
What's my plan? Do I have enough lifeboats? Does my crew know how to run those lifeboats? Well, we know at Stonebridge that we've trained the crew. We know what plan needs to be put in place in case there's market volatility, because we know there's going to be.
It's just a matter of when, right?
Yeah, over a 40-year time horizon, you're going to have, on average, maybe 4 or 5, even 6 bear markets. Okay, the longer you live, the more you're going to experience.
Right.
So it's natural for us to hear these things and be like, oh, well, hopefully that's just for those more aggressive investors. And so we run and we look at our statements to make sure that that's not what we're in or that we don't have too much there. But the reality is, with some of these things, it doesn't really matter what you were invested in. So I looked at the Dow, so the Dow Jones Industrial Average, which is not as many stocks, it's only 30 stocks, really large companies, but it's not as tech heavy as the NASDAQ. And again, it's kind of the same story. In 99, it was at about 10,000. In 07 was at 14.7. By March of 2009, it was at 6,700. Oh, that's not good. By the end of 2009, it had finally recovered. So it took a 10-year vacation. Today it's probably about 40,000 as of today. But the point is, these things are possible, so we have to have a plan in place to address them.
Yeah, I was pretty sure that's what you were going to say. And I remember back when I was traveling full-time across the country presenting as a financial educator, and it was in 2015 when the Dow had dipped and it was below 15,000 and people were freaking out, and then you look at the long-term stats and then you see where we are today. It's really, really interesting. But that being said, I think the bigger conversation here is there's really no safe place to run and hide, right? Because if someone were to pull all their money out of the stock market, let's just say, and put it into cash or shove it under their mattress, well, it could be quote unquote safer than the markets, but what you're really doing is going broke safely because you're not even keeping up with the pace of inflation, right?
Yeah, I love that way of putting it because that's really what it is. And, we've been spoiled here as savers recently because yields have been elevated due to the run up in inflation and the movements by the Federal Reserve. But at the same time, we know that that's not likely to last. And so one of my colleagues, one of our lead advisors at our firm, his name's Eli Mardok. And Eli and I were sitting down with one of his clients the other day. And right now he's got what we call a bridge, let's say. So some people call it a bucket plan, bucket 1, 2, and 3. He's in the early stages of retirement. He's not yet to Social Security drawing age. He's not yet to his pension.
Right.
So he's drawing on his safe money. And so he's had that mainly in money market. And there's trillions of dollars today in money market. Why? Because it's paying 5%.
Right, the interest rates environment that we've been in.
It's great.
Yeah, it's awesome.
But at the same time, he's well aware that ain't going to last. And so what's the plan when that goes to 3,
right,
to 2.5,
right,
to 2? Because with as much national debt as our country is carrying, and as the debt service alone approaches $1 trillion per year. I mean, here's something to put it in perspective. How many years are in 1 trillion seconds? Does anybody know?
I do not know the answer to that.
So, like, how much is 1 trillion is what we're trying to figure out. It's
Yeah.
like 32,000 years.
That's a big number.
It's insane.
Yeah.
And so when you put that in perspective, that is a real risk we have to consider as well, not just market volatility. We feel like, oh, we're being safe over here. But eventually you end up doing, Kristen, what you said is just losing money safely.
Right, yeah. Well, obviously, we have to be prepared for market recoveries, market declines. What are some key takeaways for our viewers of how to navigate these things successfully? Because it can be really scary if you're not in this every single day and looking at all the data and knowing historically where we've been. And, you know, so how do you help your clients navigate that?
Well, I think, Kristen, we've talked about it a lot on all of our shows. It's having a plan. We know, as Tim mentioned, we know markets are going to go up. We know they're going to go down. One interesting statistic that I thought I would mention, that for Hartford funds, they came out and they were looking at bear markets specifically. And for the bear markets, they typically last 289 days.
On average, right?
On average, right? And a bull market typically will average 965 days. So what does that mean? We're about 3 times longer for a bull market versus a bear market.
Right.
So that's a positive thing.
Yes.
So we need to have our money invested, but if we pull it out when the markets are down, how do we know when to go back in?
Exactly.
Because a bull market doesn't typically show up day one.
Right.
You usually realize you're in a bull market, further down the road. So it's important to have a plan in place and stick to the plan and operate it and run it. And that's why you need an advisor that's on your side, that's on your team, to make sure that we're not making those rash decisions and pulling out of the market when we shouldn't.
Yeah. Well, as we go to this next break, what would you love to say to viewers about specifically how getting this complimentary written financial plan will be able to help them navigate these types of market corrections correctly?
Yeah, I think I'd simplify it this way. There's really, the way I see it at least, our viewers out there, you have 3 options. You can keep going the way you're going and just kind of use hope as a strategy, which we all know. If you talk to any leaders of the past, whether it's business, military, hope is not a strategy, not a very successful one. Option 2 is you can just get up to speed on all of these different dynamic things we're talking about on your own. So you could be a DIY. If you want to, there's a DIY approach. It's like the Home Depot for financial markets, right? You got product providers you can go to. They're going to give you a window to the market, and then there's unlimited resources online where you can go and find out what tax policy you should be following or tax strategy to minimize your overall tax burden in retirement. Whether or not things like qualified charitable distributions or donor advised funds or Roth IRA conversions are right for you, and to what extent and how that's going to impact your Medicare, because it's all tied together. Then you have the third option, which is to find a team of elite advisors who have the experience, who have landed the plane, who this is what we do on a day-to-day basis, and that's what you'll get with Stonebridge. And what I'd invite you to do, give that number a call at the bottom of the screen, and you're going to get a complimentary written financial plan that'll cover all 5 key areas of planning: income, investment, tax, healthcare, and legacy, so that you know you have had a comprehensive review of all those areas, and you can focus on what's important to you.
Wonderful. Well said. Tim, Jeremy, thank you so much. To our viewers at home, again, that number to call to claim your complimentary written financial plan that Tim was just explaining is 866-256-7778. Or again, you're also welcome to scan that QR code, and that will get you connected as well. We'll be back with more right after this.
You know, if you think about the average American consumer, we don't talk about financial topics very often. And so we spend a lot of time at Stonebridge doing educational seminars and different things that are free of charge. If you're not educated in a topic, how do you make educated decisions? When you're working with a client, you're sitting down with them, they're a little stressed out, but after you go through the process and you really take time to educate them on not only what we're doing for them, but why we're doing it, that really gives them peace of mind, and you can see the weight just kind of drops. And when they leave, I hear all the time,
I really should have done this years ago. But sometimes there's a fear that somebody might try to sell us something. If the things that I can provide, if you don't want, don't need, or can't use those, I've got some good news for you. We're not going to sell them to you. We are fulfilling our fiduciary duty of putting their interests ahead of our own.
Welcome back to the Retirement Compass. I'm Kristen Oakley here with both Tim Kulhanek and Jeremy Gove. We've been talking today a lot about market volatility, and I think it was a really creative way, the way you set up today's conversation about, how much can your retirement accounts afford to be on vacation, meaning that they're not really working for you, right, with this market volatility. Really, I know you have a chart that you want to show. It's about having that more balanced approach.
Yep.
So let's go through this and help our viewers understand what they need to know about it.
Yeah, so if we can pull that back up, that'd be great. And so what we're looking at here is I'm just trying to illustrate the value of diversification. Now I know that's like investing 101, but what you're looking at here is different periods of market volatility and recoveries, right? So some of these bear markets followed by bull markets. On the left or the middle chart, I guess it would be middle column, you've got the S&P 500. The right-hand side is a more diversified approach, which we can give the details on that, but it's essentially a blend of different types of stock investments and bond investments. And it's pretty self-explanatory. What you find is in the bad years, you tend to outperform, but our minds, the way that the psychology, and this is the difficult thing about being an advisor, is, the S&P drops 40% from 2000 through 02. This strategy, more diversified approach, only loses about 16%, but, in the investor's mind, it's like, yeah, but I still lost money. You've got that one time period, 03 to 07, where this diversified approach felt pretty good, but all the others, it either underperformed on the upside or it still lost money on the downside. But get to the bottom and the bottom line. Total return with both situations through the end of 2023, you're basically in the same place. It's amazing. So diversification truly does work. You got basically 100% of the return of just the S&P 500 with a fraction of the risk. So this is why we do what we do. And at the end of the day, being a financial advisor and being a holistic financial planner, it's kind of like solving a puzzle. And I'm not talking about the types of puzzles that I like to do with my kids that are like the giant pieces that you put on the floor and it's a fire truck. Those are fun because I'm pretty good at those. But that's not what we're talking about today. We're talking about the type at Grandma and Grandpa's house that they had spread out on the card table with 1,000 or more pieces that it takes a week or more to try to solve. We can help you find the pieces to fit it all together so you can enjoy the retirement of your dreams.
Wonderful. Tim, Jeremy, thank you so much for being here and sharing your wealth of knowledge with our viewers once again this week. And I love that. Diversification can work even when it feels like losing. So if you need some help putting this giant puzzle together for yourself, you don't have to go it alone. The offer stands for you to receive your very own complimentary written financial plan by calling 866-256-7778. Thanks so much for being here. Be safe, be happy, be blessed. We look forward to being back with you next time on the Retirement Compass.